You got three Irish storytellers, and I'm part Irish, so I can talk about the Irish, but they're telling three different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. Forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. And Jay Powell is probably sick. He's given 6 speeches, either post-FOMC meeting press conferences or like the Brookings Institution speech at the end of November, Jackson Hole, August 26th. He keeps saying the same thing. He says, inflation is job one, period. We're not really worried about anything other than inflation, and we're not going to rest until we get it down to 2%. And he said we're going to have a recession. He didn't use the R word, but you don't need a decoder ring to figure that out. He said unemployment is going to go up, and the Jackson Hole speech, he used the word pain like 5 times in one paragraph. I've been doing this for 45 years. I've never heard a Fed chairman use the word pain. He said there's going to be a lot of pain. You're going to feel the pain, but the point is he meant it. And they've been going down that path. So what are they trying to do? They're trying to get to something called the target rate. And you say, hey, Jim, what's the target rate? Well, I don't know what the number is, but neither does Jay Powell. Nobody knows what the number is. But the theory is the target rate is the rate at which rates are high enough that inflation comes down on its own without further rate hikes. That's the definition. So what's that number? And the Fed thinks it's 5 1/4. The market somehow thinks it's like 4 3/4, which we just got to, or maybe 5, but it's most likely 5 1/4, possibly higher, but I'll settle on 5 1/4. The Fed's not there yet. They're going to have to raise another 25 basis points in March 22nd. That's next FOMC, and again in early May. That those 2 additional 25 basis point rate hikes, in addition to what we've just seen, will get you to 5 1/4. And then from there, you go to the pause, and they use the word pause, and Powell's like, that could last a year. And maybe early, mid 2024, we're looking at rate cuts, but we've got to get inflation under control. And it's not, inflation has come down a lot. If you it started dropping like a stone in July. Now I'm talking about CPI. The Fed uses, it can't be that simple with the Fed. They use PCE, personal consumption expenditure, core, meaning throw out food and fuel. Most people are like, what? That's what I spend most of my money on. But anyway, that's how the Fed does it. I always say if you want to understand the Fed, you can't use your mode. You have to put yourself in their minds, or you're just going to get it wrong. So PCE core comes out monthly, but they do a year-over-year comparison. That's what they want to make 2%. But just using CPI, which is better known, has come from round numbers again, 9, 8.7, 8.2, 7.5, 7.1, and now it's down around 6 or high 6s. That's a lot, but you're still pretty far away from 2. So nice job so far, but you're not where you want to be. And the Fed said they're not going to rest until they get there. Now here's the Fed's, I hate to use the word conundrum, but sometimes it applies. Here's the Fed's conundrum. They're raising rates and inflation's coming down. That's clear. But what they don't know is are interest rates coming down because they're raising rates, or have they already hit the terminal rate and it's coming down on its own and they just don't know it? And that's a big deal, because if they're at the terminal rate and they just don't know it and they keep tightening, which they are going to over tighten, probably already have, and this is going to be part of what throws the economy into severe recession. So that's kind of what the Fed's doing. Now, let's go to our next Irish storyteller. This is the market, and in particular, although here we probably have to distinguish between the stock market and the bond market. Bond market's a lot smarter. But the stock market is saying, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo, that the Fed will figure that out before they get to 5 1/4, before they raise rates in May, maybe even March, maybe they're done. And because of a recession, the Fed will get the wake-up call, pivot, the famous word pivot, meaning cut rates, and that will bring the economy in for a soft landing. This is the soft landing Goldilocks scenario. where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. The bond market is telling a completely different story, by the way. And this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro dollar futures yield curve, German Bunds yield curve, and then, there's a million yield curves. Pick your maturity. They're all inverted. Now, inversions happen, just meaning the longer term rate is lower than the short term rate. Now, this is in the Treasury yield curve. They're inverted from 1 month to 20 years. It's not like, people talk 2s and 5s and 5s and 10s. 1 month, a 1 month bill is yielding more than a 20-year note. Okay, that's inverted across the entire yield curve. Eurodollar futures, same thing. The inversion kicks in. It doesn't kick in immediately because the Fed does control very short-term rates and they're raising them, but the kink kicks in like in March 2023, which isn't that far away. And bunds have never been inverted. They are now. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying, no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. See, when these inversions start, sometimes they're a year forward, like, hey, look at the Eurodollar futures yield curve a year from now. That thing is inverted. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. Okay, now let's get our third storytelling. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. And I guess I'm the storyteller here, but what I see is kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They probably are at the so-called terminal rate. They just don't know it. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot to say that there could be a rate cut. It won't be in April, but rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened. They didn't look at the forward indicators I described, and they found out too late. And then they have to slam on the brakes, or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018, less than 3 months. The stock market dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped. I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down. lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. And so I agree with the market that we're going to get a pivot, but I completely disagree. In my fairy tale, Little Red Riding Hood gets eaten by the wolf.